After we have seen in objective 1 what are the main accounts used on the Lebanese chart of accounts for financial instruments and portfolio bills, we continue with objective 2, how we manage provisions for these types of financial instruments. First, we have to compare between what's known as the purchase value and inventory value. So according to each type of financial instruments, we must know what do we mean by the purchase value and inventory value. As you can see in this table, equity participations, the purchase value is known as the purchase price. So we compare between the purchase price of equity participation and inventory value represented by the actual value of equity participations. So when we have participations or shares in other company, their actual value according to the deed that represent our share and this company represents the actual value. So we compare between the purchase price and the actual value. Regarding the second type of financial instruments, blocked securities, we have to compare between purchase price also and the inventory value represented by the price in stock market, which will be the average market price during the last months. For replacement securities, the inventory value actually not priced in the stock market, it represents the potential sale value. So whenever we have a purchase value which is equal to the inventory value, so we have no increase or decrease, so we do no entry at this level. If the purchase value is less than the inventory value, it means if we are gonna sell these securities, we make a profit, so no entry needed. However, if the purchase value is greater than in the inventory value, it means if we are gonna sell this financial instrument, we are gonna make a loss. So we have to record a specific entry related to provisions. So we have to journalize provisions if the purchase value is greater than the inventory value or the market value. What is the accounting entry according to the Lebanese chart of accounts? Here we debit account 679 amortization and provisions on financial charges, and we credit one of these accounts according to the type of financial instrument that we have. So we credit 2951, which is provision for diminution in value of financial fixed assets related to equity participations, account 2953 for other blocked securities, and account 59 for placement securities. So the methodology is the same, just the number of account differs according to the type of financial security that we have. So to increase the provision, we debit 679 amortization and the provision of financial charges, and we credit one of these accounts, either 2951 for equity participation, 2953 for other blocked securities, and account 59 for placement securities. To decrease or cancel or to make a write back for a provision or refund, we debit what we credited here, accounts 2951, 2953 or 59, and we credit 779 account financial provision write back, as we did in the previous chapters for fixed assets or inventory. The same way we have a financial provision write back recorded in account 779. So by this way I either increase the provision or decrease or cancel the provisions.